LIC is the largest insurance company in India. It manages assets worth lakhs of crores, has the biggest agent network and a market share that private players can only dream of. Almost every Indian family has at least one LIC policy, but even after being such a giant, LIC stock is still undervalued and trades at a very much lower valuation compared to private insurance companies. So the big question is, why is LIC still undervalued? Is it an opportunity or a value trap? Let's understand this step by step. LIC is huge, but market doesn't care about size. Many people think big company means high valuation, but stock market does not give valuation based on size. Stock market gives valuation based on growth, profitability, efficiency and management independence. LIC is huge, but growth is moderate, profit margins are lower, costs are high, government influence is there. So market gives lower valuation to LIC. This is the first thing you need to understand. Government ownership. Government owns the majority stake in LIC. Because of this, LIC is not purely a private run profit making company. Sometimes LIC has to invest in PSU companies, support government disinvestment, buy government bonds, stabilize markets during crashes. This means LIC sometimes works like a financial arm of the Indian government, not just a business. Investors also fear that profit maximization may not always be LIC's first priority, and whenever the government is involved, market usually give lower valuation. This happens with most PSU companies. LIC shares profit with policyholders. This is the one of the biggest reasons LIC's profit look lower. LIC sells many participating policies. In these policies, profits are shared between policyholder, shareholder. So when LIC earns profit, a large portion of profit goes to policyholders as bonus. Only a smaller portion goes to shareholders. Private insurance companies sell more non-participating policies where profits mostly go to shareholders. So, private insurers have higher profit margins and LIC has a lower profit margin. And lower profit margin hence leads LIC to a lower valuation in the stock markets. Now let us talk about huge agent network and high costs LIC has. Thousands of branches, massive agent network, high commissions, high operating costs. Private insurance companies are more digital. Online policies, lower commissions, lower office costs, higher margins. So even if LIC sells more policy, private players earn more profit per policy. Stock market always rewards profitability, not volumes. Lower return ratios. Insurance companies are valued using things like EV, embedded value, ROEV, return on embedded value, value of new business, VNB margin. LIC's margin and returns ratios are lower than private insurance company, so valuation multiples is also lower. Simple concept. Market does not pay for how big you are, but market pays for how efficient you make money. LIC invests heavily in stock market. LIC is also one of the biggest investors in Indian stock market. It invests in banks, Reliance, PSU companies and many large cap stocks. So when the market falls, LIC's investment portfolio value also falls. This also affects LIC's valuation and sentiment. So LIC is not just an insurance company, it is also a big investment institution India may have. Then why do so many investors still say LIC is undervalued? Now comes the interesting part. The people who say LIC is undervalued give these reasons. First, LIC has the largest market share in India. Insurance penetration in India is still very low. India's middle class is growing, means more policy demand. LIC is increasing. Non-participating policy means higher margin business. If margin improves, profits can grow. If governments reduce their stake in future, valuation can improve. LIC's market cap is low compared to its embedded value. So the argument is LIC is not a bad company. LIC is an inefficient giant that can become efficient in the future. And if that happens, value re-rating can happen. Now let us talk about some risk involved in LIC. The risks are as follows. Government interference, slow growth compared to private players, high employee and agent costs, private insurance competition, market linked investment. So LIC is not a simple multi-bagger story. It is more like a slow moving giant. So now let's come to a conclusion. So the reason LIC is undervalued is not because people don't know LIC. Everybody knows LIC. LIC is undervalued because government ownership, profit sharing with policyholders, high operating costs, lower margin, lower efficiency and moderate growth. But in the future, if LIC improves margin, increases high policy profit policies, becomes more digital, government reduces interference, then LIC stock can see valuation re-rating. LIC is not a small company trying to become big, but LIC is a giant trying to become more efficient. And if that happens, the stock market may start valuing LIC very differently. Thank you.